What if everything you think you know about financial stability is wrong? What if the strongest signals of an approaching economic disaster are not loud, dramatic, or obvious, but quiet, subtle, and deliberately downplayed by the very institutions meant to warn you? JPMorgan Chase, led by one of the most influential voices in global finance, has been sending an alarm that almost everyone has ignored. A mystery hidden beneath rising stock markets, strong job numbers, and optimistic headlines. Because when JP Morgan issues a warning, it is never casual. It is about what SE coming next. And now they're saying something that should make every one of us pay attention. A major collapse is coming, but what exactly are they seeing? Why now? And why are so many other institutions pretending everything is fine when the data says the opposite? The answer is buried in a long chain of events, stretching back decades events filled with miscalculations, hidden risks, shortcuts, political pressure, and a repeating pattern that always ends the same way. To understand the alarm JP Morgan is sounding today, we need to step backwards into the architecture of modern finance, into the underlying plumbing of the global economy, where money moves not in bills or coins, but in complex webs of digital obligations. At the center of this web sit a handful of institutions that are far more powerful than any government, and JP Morgan is one of them. Its CEO, Jamie Dimon, has become famous, not because he's a banker, but because he's a builder and architect of strategy, a survivor of crashes, and a man known for one particular skill: predicting storms before they arrive. His most controversial warnings have come at moments when markets were euphoric right before the dot-com crash, right before the housing collapse, right before the repo market freeze. Each time, he was mocked, dismissed, or labeled overly cautious. The question now is whether this moment resembles those prior moments when everyone else sees calm, but the data shows a storm forming under the surface. The story of the present warning begins long before 2025. It begins in the aftermath of the 2008 crisis, when global leaders were desperate to rebuild trust, stability, and liquidity. Central banks slashed interest rates to zero, governments issued trillions in debt, and new regulations pushed risk out of traditional banks and into what came to be known as the shadow system private lenders. Hedge funds, money market funds, repo markets, and derivative networks functioning just outside the reach of traditional oversight. At first, this shift seemed harmless, but behind the scenes, something else was happening. The world was becoming more leveraged, more interconnected, and more dependent on low interest rates than at any point in history. When money is cheap, problems are invisible. When money becomes expensive, those problems rise to the surface all at once. That transition from cheap money to expensive money is where the present story begins to change. For nearly 15 years, interest rates were so low that entire industries rewired themselves around the assumption that borrowing was almost free. Corporations refinanced debt at near zero rates. Governments expanded spending with minimal consequence. Households grew comfortable with cheap mortgages and cheap credit, and investors chased the yield into increasingly exotic corners of the financial world. But in 2022, that world ended. Inflation turned from theory into reality. Central banks tightened aggressively, and suddenly the cost of everything — loans, credit lines, mortgages, corporate bonds, sovereign debt — began to rise sharply, but many did not. And that is where JP's warning begins to make sense. The cracks forming today are cracks created by the decisions of yesterday. As interest rates climbed, something predictable began to happen. Companies that had borrowed heavily now faced higher refinancing costs. Governments that had ballooned debt suddenly saw their budgets strained. Consumers with variable rates watched their monthly bills explode. And investment funds holding long-dated bonds started posting record losses. Yet these surface-level symptoms were nothing compared to the hidden risks underneath the silent buildup of vulnerability in the financial system as foundation. JP Morgan's internal research teams began tracking a troubling trend. Liquidity was thinning across critical markets. Treasury volatility was rising. And global debt had crossed a staggering $315 trillion, more than 3 times global GDP. But this still wasn't a collapse. What they kept their eyes on was something far more dangerous. The fact that much of this debt needed to be refinanced in 2025, 2026, and 2027 at far higher rates, and many borrowers simply couldn't afford it. This is why JP Morgan's warning is so severe. The collapse they repredicting isn't a sudden catastrophe. It's a slow-motion chain reaction that becomes unstoppable once it begins. And to see how this chain reaction forms, we must look at how the rise phase unfolded. It started with companies exploiting low rates to take on massive debt. They bought back shares, financed acquisitions, and expanded aggressively. Real estate developers borrowed based on future projections that assumed low rates forever. Governments normalized trillion-dollar deficits. The entire structure of global finance began resting on the assumption that rates could never rise significantly without causing a meltdown. Then the breaking point arrived. It wasn't one event, but a series of signals. Commercial real estate started failing first, with office vacancies hitting historic highs. Businesses that once depended on foot traffic or low borrowing costs suddenly found themselves underwater. Small and mid-sized banks began reporting mounting losses on real estate portfolios. Corporate bankruptcies jumped as companies could no longer refinance debt that used to be cheap but was now punishingly expensive. Defaults in private credit surged. Credit card delinquencies climbed. Car repossessions rose. And across the world, emerging markets saw their currencies crumble under the weight of dollar-denominated debt. Each of these failures on its own was manageable, but together they formed a pattern familiar to anyone who has studied past financial crises. Leverage becomes toxic only when liquidity disappears, and liquidity disappears only when confidence evaporates. What JPMorgan sees what their warning is truly about is that we have entered the fallback phase, the period where policymakers attempt short-term fixes to long-term structural problems. Central banks inject liquidity to stabilize markets. Governments issue new debt to cover old debt. Regulators patch vulnerabilities without resolving the root causes. Investors return to risky assets in search of returns. Consumers borrow more to cover rising expenses. And corporations restructure without addressing their core weaknesses. It is the same cycle we saw before the dot-com crash, before the housing collapse, and before the repo market freeze. Symptoms treated, causes ignored, and in every prior case, these failed fixes only delayed the inevitable while making the downturn far worse when it finally arrived. This leads us to modern parallels moments in history, where the patterns looked eerily similar. In 1929, the stock market soared while underlying credit markets quietly deteriorated. In 2000, technology stocks exploded while corporate debt ballooned out of control. In 2008, housing prices surged while subprime loans rotted beneath the surface. In 2019, repo markets froze unexpectedly, revealing hidden for each kazi, optimism, masked reality. Strong headlines hid weak foundations. Analysts dismissed risks as contained, and ordinary people were left unprepared when the crash arrived. Today, the parallels are striking. A booming stock market, record corporate debt, rising delinquencies, failing commercial real estate, shrinking liquidity, geopolitical instability, and stretched valuations all, while the largest bank in America says the system is nearing a breaking point. So what does JPMorgan expect next? Their research points to three possible outcomes. The first is a credit crunch, where lending slows drastically and companies struggle to refinance. The second is a liquidity event, where a sudden shock geopolitical, financial, or economic causes markets to freeze temporarily. The third is a full-scale recession triggered by high debt costs, falling asset prices, and weakened consumer demand. But all three are interconnected, and all three are already forming early signs. That is why they're calling this moment a dangerous knot, because the collapse is guaranteed, but because all the conditions required for one are now in place. Now, as we reach the conclusion of this story, there are three key takeaways that JPMorgan wants every individual to understand. First, crises are not born from sudden shocks. They are built slowly, invisibly, through years of decisions that seem harmless at the time. Second, debt is manageable only when growth is strong and rates are low. When both change, the entire system must recalibrate. And third, the institutions issuing warnings today are not doing it for drama. They are doing it because they have data ordinary. Their alarms are not predictions. They are signals that the system is approaching thresholds where stability can no longer be guaranteed. So the question becomes, what happens next? Will policymakers act in time? Will markets adjust gradually? Nobody knows the exact moment when a bubble bursts or a system breaks, but history shows that ignoring warnings is always costlier than preparing for possibilities. The future is unwritten, but it is not unpredictable. The patterns are here. The data is here. The signals are here, and the world's most powerful bank has spoken. If you want to understand the forces shaping the next financial era, if you want to stay ahead instead of being blindsided, and if you want to see the hidden mechanics behind global warnings like this, make sure to subscribe. These stories aren't just news, they're signals about the world we're walking into.